Dear students, welcome to this lecture video on Module 7, Liability Recognition and Non-Owner Financing. My plan is to solve a couple of problems from this module and discuss some of the important concepts. So let us start. The first problem we want to go over is this one. So question 1 on this document. So these question numbering may be different in your homework. So in this problem, we are working on analyzing and computing accrued warranty, liability, and expense. So this company sells a motor that carries 60-day unconditional warranty against product failures. From prior year's experience, Canton estimates that 3% of units sold each period will require repair at an average cost of $160 per unit. During the current period, Canton sold 150,000 units and repaired 3,600 of those units. How much warranty expense must Canton report in its current period income statement? So first of all, warranties are guarantees, right, that companies provide to repair or replace the products to their customers. So, and every year, every period, companies do that. So based on their history, company actually comes up with what percentage of their sales they expect to replace or repair, and what will be the warranty expenses. So in this case, we have to remember that for the current period, right? For the current period, the warranty expenses on the income statement and warranty liabilities on the balance sheet, they depend on the expected warranties. So for example, they're saying that they expect 3% of units sold each period will require repair, right? So we will say expected units to repair is equal to 0.03 times our total sales, right? So 150,000 units. So this will be equal to 4.5 thousand. So these many units the company expect to repair during the current period. And the actual numbers may be different, but you have to remember that when you report on the balance sheet and income statement, you report based on the expectation. So in case of balance sheet, the first question is about income statement. So warranty expense will be, you have to repair 4,500 units multiplied by, it says $160 per unit. So this will be $720,000. So I'm going to just write it here. Now part B is asking about what warranty liability related to current period sales will Canton report on its current period balance sheet. Now balance sheet, on balance sheet, first, this company expected to repair 4,500, right? When they forecasted at the beginning of the year. But eventually what happened, they actually repaired 3,600 units of those during the current year. So in future, they may have to receive more repair requests. So on an average, each year, it will be 4,500 from each year's sales. So 4,500 was in total for each year. So that is the original liability, but they have already paid for 3,600. So at the end of the year, on the balance sheet, the liability will be how much the company has not yet paid, but it anticipates that it have to pay in future. So liability is to Y here. So it will be your 4,500 units minus your 3,600 units. Times 160, right? 144,000. So times 160, 144,000. So I'll just enter it here. So that is all for question 1. So not terrible. It is very straightforward. Now let us work on this problem. Question 3 is a long one, at least in terms of amount of information you have to process. So what it is telling you here, this company has long-term borrowings, fiscal year 2, fiscal year 1. Now they're specifically talking about 840 million, 7.125% notes. So this one, they have bolded here too. So this is the book value. That's why you see it is not changing. Recent price quote from Markets Insider on Deere's 7.125% notes follows. Okay, what is the total market value of the 7.125% bonds? Now these are individual bonds, right? We are working on only this bond. Now, first of all, what does this number represent? 7.125%. So that is your annual coupon rate, which is fixed. Even if the interest rate on a similar bond in the market changes. So very important for you to remember. So for $100 annually, the company, Deere, has to pay $7.13 each year. And companies usually pay these semi-annually, so then you have to divide it by 2. Okay, now it says price. So price, it says this much. What that basically means, although this is our book value, but and first of all, this number is in percent. So this is 366.88%. So the current market price is 366.88% of the book value of the bond, right? Now, coupon I already explained. So what that basically means again, so if the book value was $100, market interest rates changed. So the market value has become now $366.88. So if the company wants to buy back the bond, they have to pay for each $100 they have raised, they have to pay back $366.88. And you remember from your other finance classes that when market interest rates increase, that leads to market price to decrease. And when market interest rates decrease, that leads to market price to increase. So you can see from here, market price increase for each $100, it is now $366.88. So you can understand that market interest rates decreased significantly. And additionally, when market price decreases, we say it is trading at a discount or discount bond. When market price increases, we say trading at a premium. Okay. And matured is, it will mature in at the end of 15th year. Now yield, this is the market interest rate now. So what we can assume is if the bond was issued in fiscal year 1, it will be due in fiscal year 15, and now is fiscal year end of fiscal year 2. So it is they don't tell us exactly, but given this information, we can assume this is the yield at the end of fiscal year 2. So that is the return, right? Yield is 2.82%. So that is return, expected return for investors. So let us solve a couple of these problems here. So A tells us what is the total market value. So we already discussed market value. So market price, what you see in the market price is, it is for each $100. So what we can do, we can take this $840 multiply by this percent. So market value will be, we have 840 million multiplied by, remember this has to be in percent, so 366.88% means 3.6688, so which will be equal to, so 840 million times 3.66. 88. So it says to the nearest dollars, I'll type 3082. So, and then it is asking, assuming that these notes were originally issued at par value. So market interest rate and coupon rates, they were the same. So that is what it means when a bond is traded at par value. What does the market price reveal about interest rate changes since Deere issued the notes? Assume that Deere's credit rating has remained the same. So there are many factors. Interest rate can increase or decrease. You remember, if you invest in a riskier asset than or security, then you expect higher return, right? So that's what they're saying. Credit rating has not changed. For a bond, credit rating is probably the most important factor. So credit rating did not increase or decrease, so that did not affect the riskiness of the bond, so that did not affect the interest rate. So that is what they're trying to tell us here. Now, what does the market price reveal about interest rate changes? So because it has become a premium bond, right? $100 book value has become $366.88. So when it's trading at a premium, interest rates decreased. So given that Deere's 7.125% debentures now trade at a premium, and assuming premium, assuming that Deere's credit ratings have not changed, we conclude that interest rate for this type of bond have decreased. Well, below so this one should be in this box. Well below 7.125% since the bonds were issued. Part C, does the change in interest rates since the issuance of this notes affect the amount of interest expense that Deere reports in its income statement? Okay. So what happens when a company issues a bond? They have annual coupon, and they so let's say it is 6%, but market is saying, given the risk of the bond and other factors, it should be 7%, right? So then the bond is actually adjusted based on the market rate. Now, after that, subsequently, interest rate can change even further, increase or decrease. Maybe the bonds, in this case, we are talking about a note, a similar principle apply. Market interest rate increase or decrease, it will not affect the initial assumptions or calculation that were set up. So the change in interest rate since Deere issued the notes do not. So does not affect interest expense. Now D, assume that Deere decided to repurchase the 7.125% notes at the quoted market price. Assume no interest is owed when Deere repurchases the notes. How would the repurchase affect Deere's current income? Now, so when they sell the bond, repurchase the bond, so repurchase amount is equal to, we already found that amount, which is the market value. So 3,082. It's here, right? So this is how much they have to pay. But what is the value of the bond to them, book value? Book value is 840. So minus this, so that will be a loss of 2,242. Do not use a negative sign. So how would the repurchase affect your current income? So it will be you will be given a drop down to choose. So then you will choose the loss. The loss on the bond repurchase would be reported on the income statement. That will, because it is a loss, that will reduce pre-tax income by what we calculated, 2,242 million. Okay. Now part E. So that was our, actually not C, that was D. Assuming that the notes remain outstanding until their maturity, at what market price will the notes sell on their due date? Remain outstanding. So what that basically means, the company will not repurchase. So if the company does not repurchase, they just have to pay back the book value, which is in this case 840 million. So 840. Okay, that is the end of question 3. Now let's do question 5. So we have to find out interest accrued. And they are payable. Compute the interest accrued for each of the notes payable as of December 31st of the current year. Assume 365-day year. So actually, these are very straightforward. So for Nissim, so what you have to do, these are annual interest rate. And it was issued November 21, November 21st. So how many days are in November? 30 days, right? So 30 minus 21 days are gone, plus the 31 days of December. So this is how many days interest will be accrued. That divided by your 365, right? And then you multiply. So this entire thing, you calculate this first, and then multiply by 10%, so 0.1, and then you multiply by the total principal, which is 165,000. So this will be first, so 30 minus 21 plus 31 is this, divided by 365, which is this. So, and then you multiply by 0.1, multiply by 165,000. So to the nearest dollars, I'll just enter $1,808. So you can follow the same process for each of these. Now, let's do this problem, question 8. So for each of the following outstanding bonds, determine whether the company would record a gain or loss if it decided to retire the bonds at the end of the current fiscal year. We actually solved this type of problem. So this is slightly different. So we have to actually find out the book value. So book value of the bond. For, let's solve for farm 1. So book value of the bond is your face value plus if there is a premium, or if there is a discount, you have to subtract. So we have 810,000 here. And then we also have a premium, so we'll add it. So that becomes so that is our book value. Now what we have to do to find out gain or loss, we have to take this amount, book value, subtract the fair value. Fair value is the market value. So fair value. So this minus so 17,800. So that is a loss. And that should make sense. The market value is higher when a company retires a bond, repurchases a bond, it has to repurchase at the market price. So higher market price than the book value of the bond. So it will incur a loss of 17,800. there is a loss, so it will be a negative. Again, 800. So again, let's do for farm 2 one more. Farm 2. So farm 2 gain or loss will be, so your book value, which is face value, plus premium or minus discount. So we have a discount here. So minus this amount. So, and then we have to subtract the face value, right? So let me write this number. So this, we already calculated the book value, and then I'll just subtract the market value. So we again have loss. Okay. So that's it for this lecture video. I hope this is helpful. I will see you next time. Have a great day. Bye.